The Federal Reserve has rubber stamped backing 40-year mortgages. Key players in the market and the Federal Reserve are talking about 40-year mortgages. We've talked about this in the past. Other people on the internet have talked about it, but it's different now. The Fed is talking about it. So let's get into it. Tim McClone, your $20 million broker. We are not just real estate brokers in the state of California and Nevada. We are a global company and we do business worldwide. And I'm currently right now in Nevada on business. And after Nevada, I'm on my way to Mexico to launch a new rental property that we'll be offering. It is going to be absolutely epic. It's been a long, arduous process, but things have finally come together for this property. And I'm going to be down in Mexico, and there's a lot of great things going on in Mexico. As I said before, I've been going down there 15 years. There's a lot of interesting stuff going on in Tulum and Mérida and Playa del Carmen. So with that said, the U.S. housing financial market has been dominated, absolutely dominated, as you all know, by the 30-year fixed rate mortgage loan for decades, my friends. Are you ready? Are you ready for a 40-year mortgage? I've been talking about this for a while and even had conversations with lenders offering it, and other people on the internet have also talked about it, but there's something a little different. The difference now is the Federal Reserve and major players are now openly talking about it, folks. And, you know, what are they signaling about the economy? Why are they talking about 40-year, 50-year mortgages? But no, they're talking about 40-year now, and it's rubber stamped by the Federal Reserve. So now some key power players in the U.S. housing market think it is time to give home buyers the option of stretching loans out to 40 years. The lower monthly payments might help some borrowers handle home price inflation, they think. Then again, ladies and gentlemen, it may not be worth adding another 10 years of loan payments. The bank owns more of your home. You're just a renter. Remember that, you know? So the president of the Federal Reserve Bank of Philadelphia, Patrick Hacker, suggested that a 40-year mortgage could function as an important solution for homeowners facing the possibility of foreclosure in the wake of COVID-19. We're talking about foreclosures now. I've been saying early on, I did a video on foreclosures, there's a default uptick across the nation. That's just a fact. So really, Patrick, let's stretch out the debt even more now. Is that just a Band-Aid right now? Should the federal government start backing mortgages even longer than 30 years? Hey, the Philadelphia Federal Reserve Bank president thinks it could be a solution to an emerging problem in the housing finance ecosystem here. So even the Department of Housing and Urban Development, proposed facilitating a 40-year mortgage, but it hasn't happened yet, but they're proposing it. So some interesting quotes, two quotes to chew on and think about. Quote number one, having access to a 40-year loan may be, critical for many homeowners with FHA, USDA, and VA loans. Number two, a 40-year rate would present another challenge for consumers as the amount of interest typically increases with the length of the mortgage. So that interest, increases with the length of the mortgage. So we got to look at both sides. The potential advantages of a 40-year loan. The obvious potential advantage of a 40-year loan is the lower monthly payment for sure. You're going to get a lower monthly payment. Before you make long-term comparisons, though, here's a chart from the Federal Reserve Bank of St. Louis showing the movement of median U.S. home sale prices since 1970. So, I think Patrick's been on a world tour. He's been having a lot of cocktails over dinner, talking to a lot of people and pushing this in a speech where Patrick called on the central bank to act more aggressively in fighting inflation. He also focused on developments in the housing market. That inflation, it's transitory. So in general, the housing market is largely healthy, he thinks, If anything, it's not keeping up with demand. That is true, Patrick, to an extent. But there are potential problems in this market. And he thinks one potential problem from his perspective on the horizon is a large number of Americans who are behind on their mortgage payments. They're behind on their mortgage payments. And that's where the 40-year mortgage might come into play. So what are they seeing behind the tea leaves there? And what are they seeing with the mortgage market, you know? So, you know, I didn't say that. That's not from me. That's from the Philly Fed. They said that. So once again, what info are they looking at internally that's got them riled up? So the Philly Fed has, you know, tracked evolving situations involving mortgage forbearance. At the start of the pandemic, lawmakers mandated that borrowers whose homes were federally insured be allowed to suspend payments amid the economic turmoil. And that was through, if you all remember, I did some talks on this, the CARES Act. Lawmakers also established a moratorium on foreclosures, no foreclosures, for loans not backed by the federal government. A lot of private lenders too, and private lenders largely adopted the same policies through, you know, some gaps that existed. So all told on their end, the data, I've seen some higher numbers. More than 8.5 million borrowers entered into mortgage forbearance. That's a lot. And at some point during the pandemic, representing over 15.6, almost 16% of the nation's mortgage market. So today, that figure has shrunk. They think to a little under 700,000, a roughly decline of about 89.6%. Nearly 3/4 of those who have exited forbearance have paid off or are performing, many making use of payment deferrals or loan modifications, the Philly Fed said. Now, those are going to have to be factored back into the loan. They're not just going to forgive that, ladies and gentlemen. Nevertheless, nearly 1 million mortgages are seriously delinquent, 1 million plus, seeing higher numbers than that, and only half of which are in loss mitigation programs. You know, that loss mitigation can include entering into forbearance, a loan modification, and other options. So many of the borrowers who have not, you know, availed themselves of loss mitigation options never, you know, entered forbearance and were behind on mortgage payments even before the COVID-19 pandemic. So when we kind of break some stuff down, Black and Hispanic borrowers currently have higher shares of mortgage non-payment, noted the Philly Fed, either because they're in forbearance or delinquent or they're on their loan. So, ladies and gentlemen, mortgage defaults are up all over the country. And without the help of the government, with the forbearance program, the eviction moratorium, we would have had a housing crash worse than 2008. So I would say, you know, why can't we survive? Why can't we survive a major crisis without the help of the government? Shouldn't all Americans have enough in reserves to survive for at least 1 year? And that's just not the case. Half of Americans only have $500 in their savings account. I'm not blaming Americans, but is that the sign of a healthy economy? It's a healthy jobs market, you know? Without the help of the government, we would have had a crash worse than 2008. So while the housing market is by no means facing a foreclosure crisis, they are saying on the magnitude that which occurred around the Great Recession. Short-term data shows that for the moment, thanks to the government in the short term, many homeowners are in a tight spot, more than you're reading about, and you have to look for the data. And the Fed is now waking up to it. So the lenders, you know, wanting lenders to consider, you know, solutions that would limit the cost to modify loans while providing borrowers with payment relief. And he pointed to, you know, their brainstorm of a 40-year mortgage specifically from the Federal Housing Administration as one such solution to the problem. You know, so the government is just rolling out 40-year loans. Last June, Ginnie Mae, the government-owned corporation that insures mortgages, created through programs run by the FHA, the Department of Veteran Affairs, and the U.S. Department of Agriculture. They announced that it would start supporting, you know, loans with terms of up to 40 years. They wouldn't be new loans, rather they would be existing mortgages, in their opinion, that would be modified by the lender into stretched out to 40-year loans to reduce the size of the monthly payment. So a loan modification for borrowers in a tight spot. So that's their perspective on it. The government overall was slow to roll out the loans. Jeannie Mae first rolled out the 40-year loan product for modified VA and USDA loans in December. So the good thing is in 2008, I tried to help some clients with loan modifications. I know people that went through it, and they didn't want to do it. They double dipped and wanted people to foreclose. So you are seeing some more checks and balances now. But as the Philly Fed pointed out, while the Department of Housing and Urban Development proposed facilitating a 40-year mortgage, it has yet to materialize for FHA loans. They have a draft for the new policy, and from what they're saying, it's been circulated last fall, and looks like it might go through. And the HUD published a proposed rule in the Federal Register that would allow for existing FHA mortgages to be modified into 40-year loans. So as I said earlier, this is talked about. I talked to lenders that are offering it, but now the Fed is pushing it. That's the difference now, what's in the news. So by extending the duration of their loans, lenders and servicers could make it easier for homeowners to manage ongoing payments as they recover from the pandemic-related financial hardships. So, and I don't think there's the recovery right now, what's going on. It just keeps going and going. So having access to a 40-year loan may be critical for many homeowners with, FHA, USDA, VA loans. Throughout the pandemic, these mortgage borrowers were likely to be in forbearance than people with loans backed by Fannie Mae and Freddie Mac. So FHA, VA, and USDA loans come with less stringent requirements in terms of credit scores and down payments, making them more popular with less affluent home buyers. But some people get into trouble. So, a 40-year, in my opinion, could be risky proposition. The 40-year mortgage modification program could serve as a testing ground right now for, the product's popularity overall. I know, like I said, people have been doing this for over a year, but now it's being pushed more. Bankers are going to own more of your loan. So let's stretch out that loan even more. Whether or not that's going to be viable is ultimately going to boil down to investor demand, and that can change with the wind. Some chief economist said from bankrate.com. So if investors were to be receptive to securities backed by loans that originally had shorter terms, but were then modified into 40-year mortgages, it could be seen as an indication that they would support such a product if lenders were, to offer home buyers and people refinancing outright. So when we talk about investors, given that investors, grease the mortgage market's wheels, their option carries a great deal of weight in the market. But the bottom line is a 40-year mortgage is far from foolproof, ladies and gentlemen, especially given where we are in the current market cycle. Home prices are very elevated across most of the country, and many economists expect the pace of home price growth to slow as mortgage rates increase. That's just a given. That's just a given right now. So if you look on the front of it, a 40-year mortgage rate would present another challenge for consumers and a potential, boom for the banks, as the amount of interest typically increases with the length of the mortgage. So why do you think the big banks want to extend your mortgage and own more of it? So, at the end of the day, you just got to follow the money trail, right? Up until now, the fast pace of home price appreciation has benefited struggling home owners. Families behind on their mortgage could rely on selling their home and benefiting from the run-up in equity. But with a 40-year mortgage, 40-year mortgage, homeowners would build up equity at a snail's pace, maybe even slower in a market where home price growth is right now, decelerating a little bit. So, that not only has implications for borrowers in terms of how much equity you're building, but whether or not you even have enough equity to pay, the transaction cost. Do you have enough equity to pay the transaction cost? So, there are some upsides and there are some challenges. I think my goal with this presentation is, why is the Federal Reserve is seeing the internal numbers. Yes, in 2008, people didn't have as much equity in their homes. And I'm seeing, when I look at internal data across the nation, but some people have more equity. There are a lot more cash buyers out there now than there were in 2008. But a lot of this stuff is going on, bundling mortgages. If you look between the lines of the data, we had, collateralized debt obligations have now turned into BTOs. There have been bundling of mortgages. So there's some strong signs of the housing market. But when the Fed comes out and says, 40-year mortgages, bank owns more of your house. I know a guy says he bought a $1.4 million house. His nut is between $6,000 to $7,000 a month, and he calls himself a millionaire. The bank owns your house. You have a mortgage. And in today's day and age, you're a millionaire if you have 10 million liquid. 10 million liquid. So that's my opinion. That's what your goal should be, is 10 million liquid. You got 1 or 2 million, you're not a millionaire. Those are the hard facts. So, it's concerning for people in tight spots and need to stay in their homes, and we don't want to flood the market with foreclosures. Getting that lower payment can have benefit, and it's an interesting product to offer in your suite of products as lenders. But it can get people into sticky trouble, and the banks are going to make more money, and that's why they want it. And you're not going to get that equity in your home, and the bank is going to own more of your home, and you're going to be in debt for life. Like I said, you're technically a renter. You have those benefits of the tax write-offs and interest write-offs, and that's the benefit of owning. But if you get yourself big time into debt on your home and pulling equity lines, and I don't encourage that, and I talk to people about this and provide training on this, the benefits of doing cash out. What are you going to use it for? Are you going to use it for vacations and go to the Maldives? Are you going to buy a car? Are you going to buy an investment property? Are you going to fix up that kitchen, add another room on your house? I see benefits to that. But I know a lot of people just dip it into their cash and, hey, I'll get a 40-year mortgage and extend it out. So it has some dangers. I want to make light of it. I do have some concerns about it, but I think for people in a tough spot, it can be a benefit to go that route. But I would try to avoid it, because your goal should be get your primary residence paid off as quickly as possible. Thanks so much. Have a great rest of your week. Take care.